Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I are going to talk about service entities. What are they, when to use them, and some common mistakes. So let me first kick off by explaining what a service entity is. Essentially, it's an entity that's separate from your business that provides services to your business. And you pay a fee to that entity in return for receiving those services. So, for example, if let's talk about an accountant, for example. If I'm an accountant and I earn a certain amount of revenue, let's say I do that through a company structure and I bill you as my client, as the accountant. The company will receive all that income. Now, if I then obviously need to employ staff and have a business premises, so I've got rent and all the other expenses associated with running an accounting practice. Let's assume that I run those expenses through a trust, and that trust then provides my company the services to run my accounting practice. Provides the staff, the facilities, all those sorts of things. I will then pay a fee from my company into that service trust. And that fee can be a little bit more than what the expenses cost, because obviously that business is actually providing a service, and no businesses do that very few businesses do that for free, of course. So I can add a margin on top of that. It means that trust will then generate some business income, and I can then distribute that business income to other parties. So if I've got a spouse that's on a lower taxable income, adult children, those sorts of potential beneficiaries, and by distributing that business income as opposed to me getting it personally, particularly if I've already got a high taxable income, I'm going to save some tax.
These types of service arrangements don't only provide tax benefits, but they also work to provide asset protection. Yep. So, for example, if all your employees are employed by that trust, it's completely separate to your actual main trading entity. So that means if you're to ever be sued for wrongful termination, for example, or something was to happen on the premises that poses some liability to you, your business trading and your goodwill and anything associated with that is completely protected from that service entity.
Yeah, correct. So what sort of businesses do service entities suit, Mena?
So it suits a lot of professional services entities, businesses, like you mentioned, accountants, financial planners, lawyers, and the like, architects as well. Also medical services, medical and allied health services. So, for example, your medical practitioners, your dentists, a lot of pharmacists use them as well. Those are the types of businesses that typically use service arrangements.
So where someone's earning personal services income, we'd probably want to start considering using a service entity, and also particularly, if you do have other potential liability issues. So I guess that depends on, what type of business you're running in terms of, what you're actually doing, and also the number of staff that you're employing. Again, you could be using a service entity to sort of quarantine those liabilities as well. So what are some of the common mistakes that we see with, the operating service entities?
It's not structured correctly. So we found a lot, even recently in the last day, we found that we had a dentist who was paying a service fee across into a service trust. However, he was paying a significantly high amount in that service trust, well above what is considered to be market rates or justifiable. So that poses a huge audit risk, and the ATO can deem the whole operation of that service trust to be not
kosher.
Yes.
Yeah. So, obviously, a service entity is just providing services. It can't make a 50% profit. Of course, that might serve you really well from a tax benefit perspective, but the ATO is going to argue that the only reason that arrangement is in existence is to avoid or reduce your tax. which of course will get caught in anti-avoidance provisions. What are some of the other problems?
So another problem is that you could not be paying enough to cover the costs associated with the service entity. So what you'll end up having is basically a main trading entity that's highly profitable and a service entity that's making losses, and you can't utilise those losses.
And then finally, the other common mistake we see is that a service entity is not really justifiable. So we need to have, other than tax, a good rationale why we have a service entity in place. And if we don't have a good rationale other than tax, then essentially what we're doing is potentially waving a red flag to the ATO. And as Mena said, if they deem it not commercial, that's going to get you into a bit of trouble from a tax perspective. So service entities, we think used correctly and administered correctly, and making sure that your accountant is all over the top of them, they can be very effectual structures, but there are some common pitfalls to be aware of that that your holistic accountant should be all over the top of. Okay, that's it for this week. Until next week, bye for now.